Ladies and gentlemen, good day, and welcome to the Q3 FY23 earnings conference call of Borosil Limited, hosted by Monarch Networth Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Dani from Monarch Networth Capital. Thank you, and over to you, Mr. Dani.
Thank you, Michelle. On behalf of Monarch Networth Capital, we welcome you to the Q3 FY23 results conference call of Borosil Limited. We have with us the senior management represented by Mr. Shreevar Kheruka, Managing Director and CEO, Mr. Anand Sultania, CFO, and Mr. Swadhin Padia, Senior General Accounts. I will hand the call over to the senior management for the opening remarks. Thank you, and over to you, Shreevar.
So thanks, Rahul and Monarch, for hosting this call. Good afternoon, everyone. Borosil Limited's board approved the company's financial results for Q3 FY23 on February 3rd, 2023. Our results and an updated presentation have been sent to the stock exchanges and have also been uploaded on the company's website. Borosil's consolidated revenue from operations for the 9 months ended December 22 was INR 768.3 crores, which is a growth of 24% over the corresponding period in the previous year. During the 9-month period, the company earned a consolidated EBITDA before exceptional and one-time items of INR 92.7 crores, which translates into an EBITDA margin of 12.1% as compared to 20% in the corresponding period in the previous year. Profit before tax during the 3 quarters ended December 22 was INR 90.2 crores. The company received an insurance claim net of non-value of INR 9.3 crores as full settlement of the claim in respect of loss of property due to fire at the company's warehouse in Borosil. During the corresponding period in the previous year, we had made a provision of INR 6.5 crores for loss of property at the company's warehouse due to fire and flood. During the third quarter, the company has also disposed one of its non-core assets, which was held for disposal, and the gain on the same is INR 13.5 crores, and the same is recognized under the head of other income. Taking all this into consideration, during the 9-month period ended December 22, Borosil recorded a consolidated PAT of INR 67.9 crores as compared to a PAT of INR 50.6 crores during the same period in the previous year. Average operating capital employed in the business, that is capital employed without CWIP and investments, was INR 525.1 crores. During the 9 months ended December 22, the company earned an operating profit before exceptional items and before income from investments of INR 67.9 crores. That translates into an annualized operating ROCE of 17.2%. Coming to our business-wise performance, Borosil's consumer business comprising glassware products and non-glassware products under the brand Borosil and its opalware range under the brand Lara recorded sales of INR 565.3 crores. That is a growth of 29.8% over the same period last year. Sales of glassware products were INR 137.8 crores, which is a growth of 26.7%. And non-glassware products grew by 49.2%. Non-glassware reached a turnover of 235 crores during the 9-month period. Glassware reached a turnover of 137.8 crores. And our opalware brand under Lara achieved sales of INR 192.4 crores, which is a growth of 14% over the same period in the previous year. The EBITDA margin during the 9 months ended December 24 consumer products was 10.5% as compared to 17.1% during the corresponding period in the previous year. The decline in EBITDA margin was due to a number of factors, including change in our product mix. And as you can see, our non-glassware products have been expanding in sales and comprise about 63% of sales of our Borosil brand, that is excluding Lara. The Hydra range of steel bottles, steel serve fresh products, as well as domestic appliances have all been achieving very healthy growth. These ranges have a lower gross margin than the traditional glassware range of business, resulting in some decline in the overall EBITDA margin. However, as I mentioned before, our focus is on return on capital. While the gross and the EBITDA margins on the non-glassware range is lower, we have not invested in manufacturing facilities for this range. We can therefore earn an acceptable ROCE from the non-glassware range as well. The company's spend on marketing expenses for the brand Borosil had been higher during the 9 months ended December 22 as compared to the same period last year. Company has invested its major marketing costs to increase the consumer mindshare and grow the brand digitally. The brand has been actively promoted through influencer marketing programs and celebrity chefs to improve customer engagement across categories. The company is a partner to the Indian Olympic Association and the Haryana Steelers, and both of these have given significant brand upliftments in the Hydra category for bottles and flasks. And third, these are some reasons for the reduction in margins. So the first, as I already mentioned, was change in the product mix. Second is higher marketing expenses. And the third is the EBITDA margin on Lara, which is our opalware range of products, was much lower than normal. As you are aware, the company is expanding its capacity from 42 to 84 tons per day by putting up an additional furnace. This furnace has gone on stream on, I think, 2nd January of 2023 from a commercial production point of view. This was delayed owing to some implementation challenges owing to global supply chain issues. Consequently, the firing of the furnace and its commercial production took place only in the beginning of this quarter. At the same time, the older furnace had to go in for its regularly scheduled rebuild in October 22. This meant that the company continued to incur fixed costs during the rebuild period and also had no production during the same period, which contributed to lower EBITDA. The net result of this was the company could not service most of Lara's requirements during Q3 FY23 and a part of H1 FY23 through internal production. However, in order to ensure continued availability of brand Lara in the market, the company took a decision to procure whiteware and introduce these into the market with our own designs and branding. And the company earned zero margin, in fact, slightly negative margin on this activity. However, it was important that Lara did not lose any potential customers on account of availability. This was a short-term strategic decision, and both will be in production during Q4 FY23, which should see normalized margins restored during this period. So these three reasons, the procurement of large volumes of whiteware from outside, the change in product mix of the Borosil, the consumer sales, as well as the higher marketing expenses, have contributed to a decline in the EBITDA. Of these three reasons, the production of Lara is already solved, and Q4 we should go back to normalized margins. Marketing expenses have been slightly higher, but we expect them also to, as a percentage of sales, rationalize as our revenues are growing higher than expected, and with our new production, the base will be higher. And as far as change in product mix is concerned, that is something likely to continue for some period of time. But the higher volume should end of day give us better margins because of our ability to negotiate on purchases on these accounts. Moving on to the scientific products division, the net sales during the 9 months ended December 22 were INR 203 crores, which is a growth of 10.2% over the corresponding period in the previous year. Our scientific product business comprises 3 product ranges: lab glassware, lab instrumentation under the brand LabQuest, and primary glass packaging for pharma customers under the brand ClassPack. During YTD Q3 FY23, lab glassware sales recorded a sale of INR 131.8 crores, which is a very nice growth of 27% over the same period last year. We continue to enjoy about 70% of the lab glass organized market and expect to get a fair share of any growth in demand from the pharma and the educational institutional sectors. The company continues to get repeat business for existing products from existing customers. It has also introduced new products such as filter papers, QR-coded glassware, and multi-pot caps, which have got good traction. Apart from new customers with the existing and new range of products, we are also developing an OEM business line for supply of critical items to our customers. The instrumentation business under LabQuest achieved a sale of INR 16.5 crores, that is a growth of 24% over the same period. We are still in the early stages of development of a range of offerings in this business vertical, and we expect the addressable serviceable market to be about INR 225 crores and growing at 10 to 12% a year. Recent products developed and introduced by the Borosil Technologies teams include pilot lab reactors, bottle top dispensers for hazardous acids, and as well as products in the nutrition and environment categories. In the context of ClassPack, due to COVID, ClassPack had 2 very strong years in FY21 and 22, registering growths of 28% and 56% respectively. During FY24, therefore, we are lapping a high base. During the 9-month period ended December 22, ClassPack achieved sales of 54.7 crores, which is a decline of 18.7% compared to the corresponding period in the previous years. This decline in sales during the current period needs to be read in the context of the high base effect. In fact, last year almost 18% of the sales were related to COVID drugs, sales of vials for COVID drugs, and exports of vials were also impacted this year owing to various reasons, owing to challenges in Europe. This was, however, more than made up by other geography, and export sales have otherwise turned a very good performance, comprising about 19% of revenue compared to 13% last year. Other challenge in glass pack has also been that input price have increased of over 25%, and this necessitated price increases, which has also had a negative impact on sales. In the past, I mentioned that we are focusing on developing deeper relationships with high quality customers, and this process is ongoing, and we expect to add new, what we call as Pharma Plus customers, the highest customers with the highest quality requirements in the next few months. EBITDA margin for scientific products during the period April to December was 16.3% as compared to 20.4% during the corresponding period in the previous year. Margins in scientific glassware have shown improvement in line with the growth of business. However, the drop in the division's EBITDA is on account of lower margins in the glass pack business that was owing to lower sales and higher cost of inputs, as well as in LabQuest, as we have decided to invest disproportionately higher in our R&D team, which is a higher staff cost, and while the current productivity and output from LabQuest is lagging behind the cost input that we're putting in there. Borosil Technologies is still a nascent business, and the subsidiary is in an investment phase, and therefore is currently incurring reasonable losses. As the business scales, these costs will get normalized, and the products may take 1 to 3 years to stabilize. In glass pack, EBITDA margin was in the low single digits. The drop in margin is attributable to the lower sales, and gross profit has also been lower owing to higher consumption costs of material and power. There's been an increase in the cost of tubing input, which has only been passed on to the customers towards the end of the period. We also took a decision at glass pack to go for camera inspections for all our products, which led to higher process rejections as we continue to raise the bar on specifications, and the automated camera-based quality control will help us improve our customer outreach in the future. These initiatives are expected to improve productivity after these initial costs and learning period is through, and after which the company should have a better set of customers to address with a higher throughput. The company has also initiated and finalized conversations to take price increases in order to pass on some of the input cost inflation and restore margins. As of December 31st, 2022, the company had a net cash of about 71.6 crores. The surplus cash will be utilized primarily for the ongoing expansion projects for the consumer and the scientific business. The expansion in Lara capacity at an estimated project cost of INR 195 crores was commissioned in December, and the commercial production has started in January 23. The new Borosil pressware facility of 25 tons per day at an estimated investment of 115 crores is estimated to be commissioned sometime in the second half of Q2 FY24. Q2 FY24. In the scientific product division, the capital outlay is continuing as per plan, and we expect these outlays also to be through by March of 24. These expansion projects indicate our optimism about the long-term growth prospects of both our consumer and scientific businesses. Some of the margin pressures that we have experienced during the first 9 months of the year are temporary in nature, and for example, I mentioned on the furnace challenge or the furnace rebuild, as well as the delay in starting of our OG2 furnace, and these are expected to be restored in the coming months. Our focus remains on expanding our consumer franchise in the consumer division and growing the size of our opportunity set in the scientific business while expanding our current relationships with customers. The consumer business is supported by tailwinds and remains underpenetrated, and we expect Borosil to have a long runway of growth. Scientific business is expected to see steady growth in lab glassware and faster growth in lab instrumentation as well as in class pack. Moreover, there are other new categories that we are planning to enter or we have just entered, including process systems. As we scale Borosil's business, we expect to achieve healthier margins in both these business units. Borosil has undertaken a structured program for implementing ESG. Last year, we had identified material issues and took stakeholder feedback. We have mapped a journey to address key ESG opportunities and identified priorities towards a greener plant, social equity, and robust governance. High priority areas for Borosil include management of waste, water, greenhouse gas emissions and energy, recyclable materials for packaging, and data and customer privacy. Over the next few quarters, we expect to disclose quantifiable targets and transparently report performance against them. We had earlier announced plans to restructure the business of the company into two separate listed entities via a composite scheme of arrangement. Post receipt of observation letters from stock exchanges and directions received from NCLT via its order dated 25th November 22, separate meetings of equity shareholders and unsecured creditors of the company have been convened on 6th February for seeking the approval to the scheme. We anticipate that the entire process can be completed by June 23. However, the timelines for some of the steps involved are not in our control, and we will keep you informed of the progress in this regard. So thank you. With that, I conclude my opening remarks. Sorry, they were a bit lengthier, but I can now open the floor for questions. Before that, I'd just like to add one broader point that while the operating results for Q3 and even YTD have not been very attractive, the real picture lies elsewhere. Our revenue growth has been extremely interesting, and I would say industry-leading revenue growth in both consumer and scientific businesses, and that has given me a lot of, let's say, confidence that whatever processes or whatever products we have established in the market are being appreciated by end customers, and the margins have definitely been under pressure this year. But many of those reasons are specific to Borosil and not macro in nature, which also means that we are able to reverse or change the inputs and therefore have a better margin in the coming months. So we remain extremely confident about the growth of the business in terms of revenue, and we expect the margins to also flow through in the next few periods. So with that, thank you, and I open the floor for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Rahul Dani from Monarch Capital. Please go ahead.
Yeah. Thanks, Shiva, and thanks for the detailed explanation. Just wanted your outlook on the consumer division. If you are seeing some division reports slow down, so how do you see with the new opalware capacity coming up? So do you think it will get absorbed very easily with both our competitors also increasing capacity? And also in the scientific division, how do you see the new product category like filter paper performing? And what's your outlook on glass pack?
Okay, so thanks for that, Rahul. As far as consumer is concerned, we have quite a few categories, right? And we do see some slowdown in some categories. For example, appliances. COVID had a very big positive impact on appliances. While we do see continued healthy growth in that area, it's not as good as it was during COVID. But on the flip side, the specific question you asked on opal, I think opal glass continues to see a very healthy demand, and we so far believe that we should be reasonably well placed to sell the production from both our furnaces, even though, as you mentioned, there is competition, increasing capacity in this area. But we also see exports, as an opportunity for us, given the macroeconomic shocks in the world from an energy point of view. Indian production costs as well as Indian geopolitical, let's say, relationships are very strong, and therefore India is being looked upon as a preferred supplier and a safe supplier of products across the board. It's not just specific to consumer. And this is giving us, tremendous, scope for growth in all export geographies for both consumer and scientific. So I'm not, I don't feel that there is any broader story of a demand slowdown. Yes, there may be one or two categories where demand is a bit slower. We are quite confident of the growth and even exceeding the growth that we've been forecasting or that we've been kind of guiding for a while. On the scientific side, while Klasspack has been a bit of a challenge this year, I think Klasspack, the focus on COVID for the last couple of years has gone away, and therefore we have to get back to, let's say, the basics of adding customers in other product categories, which we have been doing, and I think we will go back to a growth path in the next few quarters. And the guidance which we have always given for Klasspack, that 15 to 20%, I think revenue growth should be there. I think we should be able to match that guidance in that particular division. But broader scientific, I'm seeing really tremendous opportunities in new products, including filter paper. So filter paper, we had very good traction. Our next step will be to set up some degree of manufacturing of filter paper once we hit a certain volume. That should further improve margins in that area. And under Make in India today, we can't play in many of the tenders, which we will then be able to play in once we have the production in India, which will further improve the market size, let's say, for us, or the market opportunity for us. There are other areas like exports I already spoke about in scientific, as well as other new product developments. In LabQuest, we're seeing a lot of traction in specifically process systems. The orders are good, and there's a new category with a complete import substitution over there. Even we see opportunities in health and, let's say, environment for testing, for protein testing, fat testing, fiber testing. So frankly, we are very bullish and we're very excited about both our companies and both our product portfolios. And while the great thing about being diversified is when you do see demand slowdown in one, typically you're able to make up somewhere else. So overall, we have a good franchise, I believe.
Thank you so much, Shiva. Thank you and all the best.
Thanks.
Thank you. The next question is from the line of Pratik Dharamshi from Safe Enterprises. Please go ahead.
Hey, hi. Thanks a lot for giving me the opportunity to ask questions. A few from my side on the margins front for the consumer business. So you highlighted three main pain points for us. One was the mix, other was outsourcing, and the third was higher marketing spends. If I recollect correctly, in the past, I think past few quarters you have been highlighting about the raw material pressures, freight costs, etc. So have we seen the worst of it, and you reckon that we have bottomed out in terms of those sort of costs, and they are not hitting us much going forward? Second, few of the things which you mentioned, outsourcing, which is generating 0% margins. The second was as the new volumes come through from the expanded capacity, the marketing spends will rationalize. Should we expect you guys to revert back to your EBITDA margin, which was like 17-18% last year, 9 months? That would be to start with from my side.
Okay. So thanks for that. The first question, I think the cost pressures, I think we've seen the worst of it behind us. I think raw material prices, if not having corrected, they're not going up. They're not moving anymore or in the upper direction. So while they have not yet come back down to, let's say, pre-COVID levels, things like soda ash as an example, or even packing material as an example, but the price increases have stopped and they're stable, which is great. And we have seen some downward momentum as well on prices, but like I said, they're not anywhere close back to being to pre-COVID levels. Energy continues to be a challenge because the energy costs are kind of determined over the last 6 months. The fuel surcharges and all are averages of 6 months. And if you see the last every time the last 6 months, the averages are still going up. They'll probably start coming down 6 months later when because energy prices have corrected just recently. So this, in general, I see no further cost increases, substantial cost increases in the future, and maybe slight cost decreases. The next point is on the overall margin. Frankly, I would be disappointed if we just achieved the 17-18% margin before. With the economics of scale, we should definitely surpass that. There will be some period of, I think this year is a period of high capex, and once the utilization comes through, once the capacity utilization comes through, then I think the operating leverage will be substantial. Till that happens, there may be some quarters of a little bit of a depressed margin because more stuff is going into inventory, for example. And when you go into inventory, there's also cost of holding that inventory, warehousing, and so on and so on. But the key question is how quickly, with our large capexes that we are doing, we are able to achieve 80-90% capacity utilization. If this happens, which we expect to happen in a shorter period, then margins should bounce back much more than what they were before.
Fair enough. The second was, you mentioned outsourcing because of the new capacity is not there and the furnace wasn't there. Our existing furnace was out of work or technical reasons. So how much did you give for outsourcing? Can you quantify the number? Like out of the 70 odd crores of opalware sales, was it like?
I would not like to say the exact number that we bought and get into that. But what I can tell you is that owing to these two reasons, the furnace being shut and the fixed cost being there, and as well as the higher cost of outsourcing compared to our own production, I think our EBITDA loss would have been in the range of between 16 and 20 crores in this in the 9-month period. I can't put it every quarter because each quarter there would be some impact of it on at least Q2 and Q3. But Q2 and Q3 put together would somewhere be closer to the 20 crore number.
Sure. And just the last one, let me try. I tried before as well. So now the business mix is with appliances really growing fast. The non-glassware is like 40% of the business. Opalware is another close to 40, and the rest is your glassware, 25, some sort of a thing. In terms of, I understand you won't be able to quote the numbers in terms of gross margin, but in terms of at least a differential, is it like possible to quantify the differential at least in terms of gross margins?
Frankly, the gross, it doesn't, I mean, of course, we quantify it on a regular basis, but that's not something I would like to share. But what I can tell you is looking at it just from a gross margin point of view is probably, in my view, not, I mean, there's one way to look at it, but that's not the only way, okay? Because when you have a higher gross margin, as we do say in the case of Opal, Lara, and we will have this in glassware also when our new production line starts up in June, July of this year. The gross margin comes at a cost of capital employed. Okay, so one must look at a return on capital employed metric, which in my view would be much. It's a more risk-adjusted way of looking at the business versus looking at only gross margin, because we give up gross margins on one side, but what we get is much lower capital employed on the other side. So if you look at it from both perspectives, I would say both businesses would be comparable. They're not the same. They're comparable within plus minus a few percentage points of each other on a ROCE basis. So that's what I can share with you, and that's how we look at the business, not simply from a gross margin perspective.
Sure. Thanks a lot. Thank you.
Thank you. The next question is from the line of Saurabh Savla from Multi-Act. Please go ahead.
Yeah, this is Rahul Picha from Multi-Act. Thanks for the opportunity. So, wanted to understand firstly on the opalware trading side. So, you say that the traded portion, you call them as whiteware. So, are they comparable in quality to the opalware that you manufacture, or it's some other material?
Just to be clear, firstly, it's not traded. We bought raw material, which is whiteware, and we decorate it, we temper it, and we do all the quality checks on it. And the decorations are our decorations. This is full-blown production. The only thing we are buying the plates, the white plates, which aren't tempered white plates, or the bowls or whatever it is. So the quality is Borosil quality. There's no difference in the quality metrics between what sold this quarter from that versus what we make ourselves. It's 100% goes through the same quality control processes. So, and it's like I said, it's not traded. It's fully produced.
Okay.
Manufactured by us.
Okay. And after the capacity expansion that you are doing in that segment, the current capacity plus the new capacity both combined on a combined basis, what kind of annual revenues could that support?
If we are achieving 100% capacity utilization, then I think the number would be closer to 400 crores, 420 crores.
Okay. Okay, got it. And on the marketing spend, so for the consumer division, what were the marketing spends for this quarter and the 9 months in percentage terms?
This quarter, they're roughly 7%.
7% for the quarter.
Yeah, that's right.
And for the 9-month period?
More or less similar.
Okay. Okay. Thank you.
Thank you. The next question is from the line of Manav Vijay from the Financial Consultants. Please go ahead.
Yes, thank you very much, sir, for the opportunity. Sir, my first question is regarding the expansion that the company is doing. So first is the Lara, which you said is done. Second, you mentioned is the borosilicate, which will complete by Q2. If you can also enumerate what is left, which will become operational in next 2 more quarters, that will be really helpful, sir.
Yeah. So as far as the consumer, I guess your question is for consumer, right?
Sir, I'm looking at, I would say, the entire expansion that the company is doing.
Okay. So look, there is the borosilicate, the press production. We're investing roughly 115 crores. This will be concluded by June, July, August, in this time frame. Again, the reason I'm not able to give a very specific date is because of, again, supply chain challenges from some machine suppliers that we have. But broadly in that phase, we have an injection molding unit which is supposed to make plastic lids for these products. That should start somewhere in April of this year. And so these are 2 capexes both in Jaipur that we're doing. On the scientific side, we have capex done in glass pack, which is to increase our production of vials as well as ampules. And this was, I think, broadly put 65 crores there, which we had discussed about 2 years ago. And I think all of this should be through by July, August as well of this particular year, maybe by September. Again, some delays on machine supplies. And as far as we had announced a tubing project as well. The tubing project has been on hold for a certain period of time, but probably in this quarter we'll finally go ahead with that as well. And that would take, depending on the way it works, it would take anywhere from 12 months to 18 months for it to fructify. For that, the land is already available and all the infrastructure is broadly available. So it'll be a faster one to implement. So these are the main capexes. On the front end, we have done a bunch of capex on the IT side. For example, we are upgrading to our SAP to S/4HANA. We are upgrading our front end data, the data management systems. So all of that is in process. That also will be through. So the entire capex, which we have, I think, highlighted many times in the calls, let's say in the previous quarters calls, would be through by December of this year, or later say by March of 24.
And the total capex amount stands at what, sir?
I think it was roughly 600 crores, including the tubing plant. 625 crores, somewhere in that range.
Okay. Sir, my next question is on the PPT that you have issued. So on page number 8, slide number 8 of this PPT, when you provide the Concall numbers, so you provide one number of EBITDA as 39.1 crore, and then exceptional items. So I would say EBITDA before exceptional item of 21.3. So this leaves around 18 crores of difference as the exceptional item. Now, is this the exceptional item which you called out in the consumer wear as 3 items of the Lara buying from outside, the A&P, and the higher, and also the product mix?
No. That's very much a part of normal business. So that's hardly an exceptional item. The exceptional item is owing to sale of land at Tarapur, which was about 13 crores profit, 13.5 crores of profit booked in that. It's a refund we got of roughly 4 crores, which were the exceptional items which are one-off in nature. Those 3 things which I mentioned on Lara and all, that's a part of normal business and is accounted as such.
But so 13 crores of profit that you have booked by selling the land in Tarapur is actually forms part of the other income. Am I right?
Yes, that's right.
So I'm talking about what you disclosed is an EBITDA of 21.3 crores, and then in the PPT you mention EBITDA before exceptional items of 39 crores. So I'm just trying to understand this. So I would say this 18 crores of exceptional. So what this number is all about? This 13 crores of profit that you have made from sale of land forms part of other income.
That's right. So we are trying to explain what is the EBITDA from operations. Okay. So the EBITDA from operations is 21.3 crores.
Correct.
With exceptional items, EBITDA goes up to 39.1 crores. Okay. Those exceptional items are the sale of land, which is the Tarapur property, which is roughly 13 crores of profit booked there, and another 4 odd crores from insurance. So that's the difference. It's 17.8 crores, which you see between 21.3 and 39.1. The difference is coming from there. So this EBITDA, which you see is the reported EBITDA, this includes those exceptional items. We are trying to call it out. Last year, as you can see, the EBITDA and the EBITDA before exceptional items on the same slide is the exact same number. But this year we try to, in order to show our operating performance, because neither the insurance nor the sale of Tarapur is a part of operating performance, our EBITDA was actually 21.3 crores and not 39.1 crores, which is reported. Because when you do other income, you're right, it's coming in other income. When you look at the results, the other income is already coming as a part of the EBITDA. But we are trying to show you that the EBITDA is not actually 39, it's lower than that. The EBITDA from operations that I'm saying is lower than 39.
Sure. Okay. So my next question is now on Lara. So couple of quarters you had mentioned that now in the anticipation of this new furnace becoming operational, you have put up a sales team so that as and when this furnace becomes operational, you will start to hit the ground running in terms of sales from very early. Now, if you can, let's say, help us to explain so in terms of efforts that team would have made, by when can we expect, let's say, a 40, 50, 60% kind of utilization from the new furnace, including the old one, I believe the old one would be running at full, but the new one?
40-50% you'll get should start immediately.
Okay.
The question is how to get to 100%. That's really the focus.
Okay. So, sir, by when, so I would say, so since that sales team is now there for I would say last few quarters with you, how soon can we expect this thing to happen?
Look, it's hard to give an exact timeline, but in general, the reason we put up a furnace is because our sales requirements. I'm not sure exactly what you're referring to about sales team, because our sales teams have been growing for many years now. But in general, the point here is that we expect 30, 40, 50% capacity utilization from the starting point itself, from day one itself, and that should happen immediately. The key challenge is not that. The key challenge is how do I get to 100%? How do we get to 100%? Which is, as per our projections, will happen next year, and we would like really. When I say next year, I mean in 24-25, and we would really like it to happen in 23-24. That's really the difference, and we are trying to achieve that. We are trying to achieve our goal would be to achieve 100% capacity utilization in 23-24 itself. That may not be a realistic stretched goal, but by 24-25, I'm reasonably confident we can achieve that 100% number. And as far as 30, 40, 50%, that should happen straight away from this quarter itself. Okay.
Last question. So you had enumerated.
Sir, I would request you to rejoin the queue for follow-up questions.
Sure.
Please.
Thanks.
There are many others. Thank you, sir. We have the next question from the line of Vaibhav Gogate from Ashmore Group. Please go ahead.
Thanks for the opportunity. I joined the call a bit late. I just wanted to know the reasons that led to a low EBITDA margin this quarter, and how do we look at margins in the upcoming quarters? What are the key headwinds that you sort of expect will go away?
So, Vaibhav, I already explained this in detail during the call. So, rather than repeat, what I would urge you to do is I'll ask my IR team to send you the call transcript. So, because otherwise, just repeat it. It's a very long explanation.
Yeah, sure.
Yeah, I hope that works for you.
Yeah. Thank you.
Thank you. The next question is from the line of Atithi Bhattad from Niveshaay. Please go ahead.
Hello.
Yeah,
Hi,
please go ahead.
good evening, everyone. So my first question is from the glass tubing capex that was kept on hold. So you just mentioned that you will be carrying it on from this quarter. So to my understanding, this capex, you are not looking for any other alternatives now, and till the time it is operational, our requirement will be imported. So what was happening till now? Is it right?
See, yeah, I mean, we are working on what are the exact options available to us. We are evaluating all options, but I think we will take a final call on which option to pursue before the quarter ends.
Okay. And the glass tubing cost, which we see an increase in prices since the last quarter, do you see that to normalize in the coming quarters?
Yeah, in general, the main reason for the increase in pricing was the freight costs, which had skyrocketed, and those freight costs have since gone back down to more or less before COVID, and therefore our tubing costs have corrected substantially.
Okay. And my next question is from the pressware facility. So when we see the pressware facility being operational from the quarter 1 or quarter 2 of financial year 24, so how much percentage do we see the offset and imports that we are currently doing from China, outsourcing it from China?
So as far as all the pressware we are buying today from China, not just China, we buy from Europe also, we will be able to substitute 100% of that with our own production.
Okay. And what is the quantum of revenue that you see from the pressware facility?
Look, here there's a big gap between what we currently sell and what pressware production we'll have. Okay, so I think we will have somewhere close to 6,000 tons per annum, but our sales may only be 2,500 tons per annum at the moment. So currently, 40% of we see 40% capacity utilization, and that's the biggest challenge going forward, is how do we go again from 40 to 100% capacity utilization. And that's what we are working on in terms of new product development, in terms of distribution enhancement, in terms of export sales. So I hope this will not happen in year one for sure. Like in the case of Opal, we have a chance that our second furnace we can sell within a year, and it's cheap. But the pressware will take at least a couple of years for us to come to 80, 90, 100% capacity utilization. And even if we achieve that, that will be a very good achievement for us. But the margins are worth it because, the return on capital will be extremely attractive if you're able to do that.
Okay. Thank you.
Thanks.
That's all from my side.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. The next question is from the line of Jay Modi from EIML. Please go ahead.
Yeah, sir, I had a couple of questions around consumer business. So one was, when we look at our 9 months, 3 years CAGR for this division, the glassware as a business has been growing only in mid-single digits. Now, is this how we should look at the growth for this category, and incrementally all the growth will be driven by non-glassware and opalware, or for multiple of other reasons, the glassware currently would be showing subdued growth and this would likely pick up going forward?
No, frankly, the whole reason to put up the production here is to grow this business aggressively, the glassware, and we believe we can. The challenge in the business has been a substantial increase of procurement costs, which we have been passing on to the end customer. And at some point, the end customer is not wanting to pay for it. So when we have our own production here, we should be able to give the customer a value proposition that makes it an everyday use product. Why is Opal grown so much and why has the non-glassware, like say appliances or Hydra, grown so much, is because as a product family, customers are using these product families on a day-to-day basis, whereas the glassware people are using only on occasions, and that is because of the pricing. So we would have to give an attractive offering to the end customer and say, okay, glass है टूट जाएगा भी तो problem नहीं है, आपको मतलब उतना महंगा नहीं है, you can replace it. So that is really the key driver for us, to give an attractive price offering to the end customer and make them more accustomed to serving, eating, storing in glassware. If that happens, then we are through. And unfortunately, in the last 3 years, because of the tremendous price pressures of imports from both Europe and China, both in terms of material costs, energy costs, as well as the freight costs, we had to take a lot of price increases, which we can reverse once this is made in India.
And this, so the borosilicate press line is predominantly to backward integrate for these glassware products that we are currently selling.
Exactly right.
Okay. And earlier you mentioned that 40% of the capacity will be utilized for captive consumption. So this 40% essentially substitutes our import by 100%.
That's right.
Is that how it works? And what would be the cost savings that we would have on this backward integration?
I think it's more than 30%.
Okay. So secondly, it was around the marketing expenses. You mentioned one of the reasons being higher marketing spends for subdued EBITDA margin in consumer business. But when we look at your historical range, it has been in the range of 7 to 8%, right? The spends in consumer business?
I think last 2 years, COVID years, have been lower than that. But yes, before COVID, it was higher again. You're right.
Okay, so 7 to 8% has been the normalized range pre-COVID as well.
Yeah, pre-COVID it was. Then during COVID, of course, we reduced the spends, but now they're going back to pre-COVID levels.
Got it. And these would largely be advertisement spends or even promotional activities were part of this?
No, this is, so I mean, there's many ways of, the definition of promotional activities needs to be clearly understood, but effectively, this is mostly advertising spends. Promotions, so any kind of price promotion is added in sales only. So meaning that's not a part of this. But sometimes there are promotions which are linked to, let's say, a price strip for a distributor, which is on achievement of a certain, let's say, or even for a retailer for that matter, for achievement of a certain volume of sales at the end of the year. That would classify as a sales promotion expense, and that is a part of this advertisement and sales promotion. But any price discounts or customer offers which are anything related to pricing is coming from the sales.
Got it. And then I had a question on the margin. So earlier you alluded to the question that you would likely reach back or exceed your 17-18% margin that you've historically done. But until we have our utilization on press line and 100% utilization in opalware, so for FY24, these margins would likely be tending towards the lower range, and it was only by FY25 that we'll see a pickup?
Frankly, FY24 also, I think we should come back at least to this range, because I mean, I gave a number earlier in the call about the difference of this quarter and last 4 or 5 months on the difference of whether if you had manufactured the same product which we acquired, as well as the shutdown costs. So my sense is that we should be able to come back to the original margin level in the coming period or periods themselves, and higher. Yes, to get a higher margin than before, I think we would probably look at the period where our utilization is better, in which case I think it's safe to say that it could happen post April 24.
Got it. And sir, how has the demand scenario been for the month of January? And also, have we seen any competitive pressures with respect to pricing or import products when it comes to opalware specifically?
So I don't want to talk about quarter on quarter. In general, I can't speak of January specifically, but I would say that in general, and this question was asked in a different way earlier also, that different categories, we see some months higher demand and other months lower demand. But overall, I don't see much challenge from a market demand angle. And pricing pressure, I think all the players are quite mature in the market. There's enough demand, whether in domestic or export markets, and I don't see that high level of pricing pressure in the market, frankly.
Got it. And so this last question from my side was on the capex. So you said around 600 crores of total capex is what we are doing.
That's right.
Is that okay? So this is. Can you break this down? So we have the breakup for consumer business, and what is the amount which is going in scientific business? I mean, between class pack and other segments.
I can just come back to you on this. This number was shared before, but I don't have it right now. Exact numbers. I can come back to you on this.
Okay. That's it from my side, sir. Thank you.
Thank you. The next question is from the line of Priyank Chheda from Vallum Capital. Please go ahead.
Hi. Thanks for the opportunity. Sir, I just wanted, I heard you that you said that there are chances of a new capacity in the opalware getting sold within a year. So just wanted to understand what are the demand drivers for this category while the other kitchen appliances are witnessing a slowdown from the COVID pent-ups that we have seen. So specifically looking for the steps that the players like you or the market leaders are undertaking to convert this category into a strong demand.
I think there's a lot of replacement happening here. Look, there's no formal research, so anything is basis just ideas we get from the market, and they are not validated by third parties. But my sense is, in principle, that there is a lot of replacement demand, which is happening, change from steel and plastic to melamine. People in general want to upgrade their lifestyles, and opal is very, very price attractive from an end usage point of view. It's very attractive from a design perspective. You can microwave it and so on. So even if the market overall may be having a slower growth, but because of the replacement from one product category to the other, I think opal is a little bit insulated. Plus, like I said, HoReCa, hotels, restaurants, catering is opening up again after COVID, and that is also a demand driver. And finally, exports. Our competitors for opal, which were in Europe, are in severe financial distress, and therefore they have shut down some production, and therefore export opportunities are also open for all the players here. So these are the three probably reasons why we see that opal glass is still growing.
Sure. So I'll try my luck once again. I know you do not disclose the margins with the categories within the consumer. Just wanted to have a sense around the indicative margins on the steady state level. What would be the margins for the opalware, and in case post capacity addition, would the margin profile change significantly, or would it remain same?
Sorry, I'm sorry I can't share that data with you, but I can tell you that operating leverage, which is the second part of the question, yes, there will be some level of operating leverage, and that could increase our margins by 3-4% compared to what it were before. So I think the Lara EBITDA margins we have shared, EBITDA, not gross margins in the past, and they were around 27-28%. So so in that range, and the EBITDA margins could improve once we have the full capacity utilization by 3-4% basis operating leverage.
Thank you.
Thank you. The next question is from the line of Amrish Kakkar, an individual investor. Please go ahead.
Thank you for the opportunity, and congratulations on a very good set of revenue numbers. Shame we just missed the 1,000 crore mark by a little bit over 12 months. So two questions. First one on operating capital. Is there something we should read into the decline we're having quarter on quarter, or are there too many moving parts in this quarter to really think about that seriously?
No, nothing to. It's all business as usual. There's nothing really going on over there. There's a lot of moving parts.
Nothing to do with lower inventory because we didn't have own production, etc.
I mean, there was slight lower inventory, no doubt about that, but it was made up from other areas where we had more inventory. So I don't think there is. I mean, we are not controlling for that number, frankly. We're controlling for sales and profitability. The operating the capital employed, where the inventory, obviously we try and optimize it, but that's not a strict, let's say, that's not, the inventory is not the goal. The goal is to sell more.
Sure. The second question is on the scheme of arrangement, the restructuring. Is there anything you can share at this stage on where you see your role? And as a request, would it be possible also to introduce us to the presidents of the two divisions, perhaps from the next call, just so we can get more familiar with them?
Yeah. So that's the idea is that from the next, as soon as the scheme of arrangement is done, the heads of the business units will start taking these calls. As far as my role is concerned, frankly, the businesses are anyway operated as separate units, and frankly, the scheme of arrangement only captures in a legal format what has been happening in the last many years. So I don't anticipate any change per se in my role. Obviously, because of legal reasons, I have to be MD of one company. I don't think I can do both. So I have to figure that bit out. But in principle, the business operations is business as usual from our perspective, because that's how the business has been run and will continue to be run.
Thank you, sir. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thanks, Michelle. Well, thank you all for lively set of questions. Really appreciate it. Like I said before, we are very bullish and excited about not just what's happened in the past, but what's going to happen in the future. The margins definitely have been under pressure in this period, but again, the good thing is that most of these problems or these challenges are related specifically to Borosil and therefore in our control, and not macro challenges. And therefore, we feel reasonably confident that we should be able to get back to levels before and even exceed them. Our main challenge here is really capacity utilization of the borosilicate furnace and how quickly we can achieve that. Of course, the opal glass furnace, we have more reasons to believe that we should be able to achieve a higher level faster than we had originally anticipated. But the borosilicate glass furnace, we need to spend a lot of thought on how do we make that product category everyday use. And if we are able to successfully do that, I think we would solve that capacity utilization problem. On the scientific side, the things are broadly on track. Glasspack and Borosil technology has been a drag on margins and Glasspack on revenue growth also, at least for this year. But if we look at the larger themes, there are many green shoots in Borosil technologies which we are seeing develop, and Glasspack should come back to a level of growth and therefore better operating margins. So both of these divisions will do well, I think, in the periods ahead, and we should be able to be market leading in terms of growth and profitability in both of these areas. So with that, I thank you all and look forward to interacting in the next quarter.
Thank you, sir. On behalf of Monarch Network Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.